What's going on, everybody? It is Thursday, October 13th. Nice bounce in the market today, and that came after, I guess, a disappointing CPI. The CPI number came in higher than the forecast. The headline number was up 0.4, and that was expected to be up 0.2. And the core was up 0.6. That was expected to be up 0.4. There was a big downdraft. I think the market was down about 500 something, and then big turnaround, and we ended up 800 something. So I want to cover a topic today. I think it should be interesting, and this came from somebody who asked me in the comments. And if you have questions, please put your questions in the comments, and I'll try to get to it. But somebody asked me, Mike, can you explain these central bank liquidity swaps? He read something, and there was some news that recently in the last week or so, the Fed gave or lent out $3 billion to the Swiss National Bank. And I believe that number, I just checked it again today, that's up to $6.2 billion to the Swiss National Bank, and also about $300 million to the ECB. $300 million for central banks. It's kind of like chump change, but the $6.2 billion is something that is big, at least in recent history, and I'm saying like in the past 7, 8, 9 months. So let me talk about what these swap lines are. Basically, the Fed has arrangements with other major central banks like the Swiss National Bank, the Bank of England, the Bank of Japan, Bank of Canada, Australian National Bank, the RBNZ in New Zealand, and a couple other ones. The Fed has arrangements where, if needed, the Fed will lend dollars to these central banks in a swap arrangement. In other words, they'll swap it for their currency. If they're doing it with the Swiss National Bank, basically the collateral it puts up is Swiss francs, and these swap lines have a term. They could be a couple of days, they could be a week, they could be a couple of weeks, but the Fed is comfortable with these arrangements because these are major central banks, and also it feels like it has the collateral, which is the foreign currency, but I'm gonna talk about that in a minute. So we know that from time to time, and around the world, many institutions and businesses, they transact in dollars, and many of them have debts denominated in dollars, right? And from time to time, a situation can arise where, because of short-term liquidity problems or something, they may be short dollars and they need that, and the only place they can get it is from the Fed. So the Fed will provide these dollars. It's basically like a short-term loan. The Fed will provide these dollars to assist, and it's not for the central banks themselves, but what happens is, like, the central banks, let's say for example the Swiss National Bank, they might have some entity within their system. It could be a bank like Credit Suisse, and I think that's what this $6.2 billion is related to. Some entity within their system, a bank in their system, a financial institution in their system, it could be a large corporate entity in their system. The Swiss National Bank or the ECB will provide those dollars to that entity to meet whatever dollar liability they need to meet. And this way, by providing these dollars, it precludes something that might be very disruptive in the system, like some kind of a liquidity crisis, okay? And then the central bank gets paid back by the entity, and then the central bank pays the swap is unwound, where the Swiss francs go back to the Swiss National Bank, and the dollars are back at the Fed. And it doesn't actually go over there. This is all bookkeeping entries. The dollars always stay at the Fed, but it stays at the Swiss National Bank's account at the Fed, and the Fed's Swiss francs stay at the Fed's account at the Swiss National Bank. Okay, it just gets credited to the Fed, and the dollars here get credited to the Swiss National Bank. What's interesting about these swap lines, and I'm going to give you some history, because going back to basically 2008, when they started, the Fed started with these things in 2008, in the midst of the financial crisis, at one point, these swap lines reached a peak of almost 600 billion on the Fed's books. So the Fed had doled out almost 600 billion to foreign central banks, which was then lent out to entities within these central bank systems. And I remember at the time, it was wild, because I was talking about this on my blog, Mike Norman Economics, and I was saying, like, at the time this was going on, Congress was having this big heated debate about bailing out General Motors, if you could remember that. And I think the bailout for General Motors was like 11 billion or 12 billion, maybe it was 18 billion, I don't remember, but it was like around that level. And it was like, we shouldn't do this. And I'm thinking, and I was screaming at the top of my lungs, not to these people, of course, I have no access to them, but on my blog, I'm saying, the Fed is lending out almost 600 billion to foreign entities. And I remember reading that Volkswagen got some of this money. Siemens got some of this money. I think Toyota or Honda got some of this money. And like, we can't bail out our own, corporation, General Motors, a long history, employs a lot of people here. Whether you want to make that argument or not, I was saying the hypocrisy, like, here's the Fed, and nobody was questioning that. Nobody was questioning that. It was those swap lines at that time were the biggest asset on the Fed's books, bigger than the amount of treasuries that it held. Here's the clip. Okay, let me show you what happened with these swap lines. This is the data from the Fed, and you can see that here in 2008, December 2008, these hit a peak of 582 billion. These were actually the largest asset on the Fed's books at the time. 582 billion basically were short-term loans given to foreign central banks, and those foreign central banks basically handed out those dollars to entities within their system. So like, it could be banks within the Eurozone. It could have been at one point, I think Volkswagen, the big corporations, German corporations got this money. Japan, who knows who got it? Honda, Toyota, and then again we see in May 2020 these were extended out. You had 449, almost 450 billion on the Fed's books. And these are short term. I mean, they've been paid back, but now they're down to 3.3 billion. Hi, there's one thing I forgot to mention, and it's very important that I tell you this. All right? Because when the Fed engages in these swap lines, and nobody really pays a lot of attention to it, but there is unlimited risk for the Fed. It's not like the Fed, buying U.S. government securities where there's zero risk. The Treasury can always make good on those securities. When the Fed engages in these swap lines and takes a foreign currency as collateral for US dollar loans, there is unlimited foreign exchange risk. So like if we go back to that example I gave you in 2008 where there was almost 600 billion of these swap lines outstanding, not one single politician said anything, even though there was unlimited risk to the Fed. Okay, it's not a high likelihood, I'll say that, but the foreign currency can devalue quickly to the point where the foreign central bank is not able to meet its obligation to pay back those swap lines. So this is something you have to understand. When the Fed engages in those swap lines, it's kind of like going outside the boundaries of what its normal activities are, where, you know, it could discount U.S. Treasuries or bank loans, you know, stuff that, I mean, in the case of Treasuries, it's virtually zero risk. But when it takes on foreign currency as collateral, think about it. That's unlimited foreign exchange risk. And nobody said anything. And we were haggling over whether or not to bail out General Motors, which right now is a viable concern. It's an ongoing company. It employs people. It makes stuff. But back then, the Fed was giving out almost, you know, 2/3 of $1 trillion with unlimited risk. Think about that. So you see what I'm talking about. We had that gigantic spike, and the hypocrisy of that again is that those loans, those dollar loans, they were going to corporate entities and banks, but also major corporate entities in Europe and Japan, all over the place. And there wasn't a peep about this in Congress. I mean, it was incredible. I was going crazy almost every day. I mean, if you go to my blog, mikenorman.blogspot.com, I'll put the link. I mean, and if you just, in the search box, if you put swap lines, you'll see how many articles I posted on that. I mean, it was just unbelievable because on the one hand, I was watching Congress, you know, really have this very heated debate about should we bail out General Motors, you know, our corporation, our workers, you know, industrial production, manufacturing in this country. We didn't want to do it. It was, you know, it was something that it took a lot of debate and a lot of cajoling, and finally we did it. And it's like after we did it, there was all this complaining. But at the same time, I mean, we were literally bailing out Volkswagen. The Fed was bailing out Volkswagen. The Fed was bailing out Siemens, these giant corporations, Honda, Toyota. I mean, the money was going to banks as well. So it was really, really an incredible thing. But anyway, we haven't seen much, as I showed you in the data. There hasn't been much going on in these swap lines, which I found to be quite interesting, and I'll tell you why. Because the dollar's been going up and up and up. Interest rates, dollar interest rates, as everyone knows, have been going up because the Fed's been raising rates. So financing costs in dollar terms has been getting really, really expensive. In other words, if you're a foreign entity and you borrowed in dollars, your borrowing cost is going up, both in the sense of the interest rate that you paid and, you know, the cost of dollars. The dollar's just been skyrocketing, right? So like you would think that under these circumstances that these swap lines would be blowing up again. Like I was expecting to see these swap lines really start to blow up. But they haven't. I mean, they've been very, very tame, which means like, it says to me like there's not really, the world is not really short dollars like in an acute way where they're being squeezed. But now we see this 6 billion going to Switzerland, and I'm pretty sure that has to do with Credit Suisse. Credit Suisse is supposedly like in big trouble financially now. They're probably on the hook for dollars. They needed this. Hang on. And it is coming down hard here. It is raining and the sky is dark, and man, it is really coming down. So like we saw this 6 billion, but I'll tell you something that's very interesting. The past two times, I showed you that video when we had that spike in 2008 with these swap lines, and then we had that spike in 2020 with these swap lines. Both of those times were the peak in the dollar rally. And it's almost like, if you think about, you know, and again, I can relate to this as a former floor trader on the exchange. You know, let's say the pit, we're short. We're always short. And the market's creeping up, it's creeping up, it's creeping up, and nobody's getting really panicky or anything like that. But it keeps creeping up, and then we start to see some short covering come in, some buying, and then all of a sudden it just explodes. Everybody has to get out. And it was like boom, and you could hear it. The noise level goes up. You know, people are just like jumping in front of each other, bidding higher and higher. There are no offers. And you always knew that was the top. At least that was the top, you know, for the day, the move. And it was like the same thing I saw with these swap lines, that, you know, they're kind of like nothing going on, nothing going on. They start creeping up, creeping up. Then all of a sudden, everybody comes to the Fed window. We need dollars, we need dollars. And then boom, the Fed could supply unlimited, right? I mean, just whatever the system needs. And that's like that's like the stop loss. Everyone gets blown out. Everyone gets stopped out. And then the dollar starts coming down again. Now, I don't know if this 6 billion in Switzerland is the top. You know, it is a big jump compared to where we've been over the past, you know, weeks. I mean, we've been in the 100 millions, which like in central bank terms is minuscule. It's nothing. But it might be something. I think it's a sign anyway that, you know, some of these institutions, at least one of them or a couple in Switzerland, are starting to feel some pain. And they're telling the Swiss National Bank, hey, get us some dollars because we're in trouble right now. We're getting squeezed and we need the dollars. And the Swiss bank goes to the Fed and said, okay, can you provide us? And boom, it's done. I will put the link below to my blog entries back in 2008. Check them out. And I will also put the link to the New York Fed's page where you can follow these swap lines on a day-to-day basis. They give you the amount, they give you who it went to, and then you could also get, they also have in Excel format or a PDF, a list of all the central banks and what they have taken and what their position is. So, you know, if you're interested in following these swap lines, they're there. I'll also put in the link to what I just showed you from the Federal Reserve in St. Louis that has the historical readout of these swap lines. Anyway, something's going on. I hope something wasn't struck by lightning. I mean, you can hear the sirens going crazy. And those are, by the way, when you hear those sirens like that, those are ambulances. It's not far from where I live. We have major hospitals here. We have Cornell Weill. We have New York Presbyterian. These are major hospitals. So when you hear sirens like that, like police sirens are completely different, okay? And fire department, fire engine sirens are completely different. Sirens that you just heard right now, those are ambulances. So I hope people are all right. But anyway, that's the deal with those swap lines. Fascinating thing and by the way, I include those every week in my report because, I mean, it's just, I don't know, I think it's an interesting thing to follow. It's sometimes trade worthy. In other words, when you see that thing spike, it's telling you something. it's telling you that a system, and when I say system, I mean a monetary system like the Eurozone system, the yen system, the Bank of England system. A system somewhere is short dollars, and now they're kind of panicking to get out. They got to go to the Fed, please, can you give us dollars? Not every central bank has this relationship with the Fed. So it's like a privileged kind of deal. And I think last year, or maybe actually it was in 2020 during the pandemic, I think they expanded the list of members. They added a few more members. In the beginning, when it first started, it was basically, Swiss National Bank, Bank of England, Bank of Japan, Bank of Canada, Bank of Australia, and New Zealand. And they added some more in there. So that's it for now, folks. I hope that clarifies it. It's a cool thing. And we'll see what happens. I mean, like I said, in the past, when this thing spikes up, that's a dollar top. But 6 billion, compared to prior tops, we had 450 billion outstanding in May of 2020, and we had almost 600 billion outstanding in December of 2008. So compared to those numbers, 6 billion is not a lot, but we'll see. All right, everybody. Bye. Hi, there's one thing I forgot to mention, and it's very important that I tell you this. All right? Because when the Fed engages in these swap lines, and nobody really pays a lot of attention to it, but there is unlimited risk for the Fed. It's not like the Fed, buying U.S. government securities where there's zero risk. The Treasury can always make good on those securities. When the Fed engages in these swap lines and takes a foreign currency as collateral for U.S. dollar loans, there is unlimited foreign exchange risk. So like if we go back to that example I gave you in 2008 where there was almost 600 billion of these swap lines outstanding, not one single politician said anything, even though there was unlimited risk to the Fed. Okay, it's not a high likelihood, I'll say that, but the foreign currency can devalue quickly to the point where the foreign central bank is not able to meet its obligation to pay back those swap lines. So this is something you have to understand. When the Fed engages in those swap lines, it's kind of like going outside the boundaries of what its normal activities are, where, it could discount U.S. Treasuries or bank loans, stuff that, in the case of Treasuries, it's virtually zero risk. But when it takes on foreign currency as collateral, think about it. That's unlimited foreign exchange risk. And nobody said anything. And we were haggling over whether or not to bail out General Motors, which right now is a viable concern. It's an ongoing company. It employs people. It makes stuff. But back then, the Fed was giving out almost, $2/3 of $1 trillion with unlimited risk. Think about that.